Welcome to PwC IFRS Talks, your source of all things IFRS, technical accounting matters, business issues and regulatory updates. I'm your host Dave Walters. In today's episode I'm going to be talking with Peter Hogarth, our Senior Technical Partner here in the UK, focusing on the areas that regulators will be have at the top of their radars as we go through the next reporting season. So welcome Peter.
Welcome to you too, Dave. Good to be back.
Excellent. So we've got the topic of regulators. Our regulator here in the UK, the FRC, have been very busy recently with a few publications. Do you want to take us through what we are seeing?
Sure. It's at the date we're recording this, it's early November, and we've come off the back of what's been a rather busy month for the Financial Reporting Council, the FRC. October every year they've produced their annual review of corporate reporting, a sort of state of the nation publication, and this year's no different. The annual review of corporate reporting 2018-2019 was published in the last week of October. But that's accompanied by a wide range of publications. 4 thematic reviews on particular aspects of financial reporting were published just before, in most cases, and just after, in one case, the annual review. And there's also an open letter that is included within the annual review, but also published separately on matters that are of particular interest to finance directors, audit committee chairs, matters they might consider when concluding the next round of annual reports. Now, this was late October. The FRC is one of many regulators, financial reporting enforcers, you might call them, although it's a rather scary term, yes. Within the European Union, and the European Securities and Markets Authority, ESMA, just before the FRC published their documents, released its enforcement priorities for the current year. And there's a great deal of similarity between those areas that ESMA would like to see European enforcers focusing on and those that the FRC has then said it will be focusing on. So that's not surprising, really, is it? Now, we could, during the course of this conversation, say, well, ESMA say this, FRC say that. I think that would be terribly unhelpful. Yeah. So what, if it's okay with you, we can just talk about is those areas which, frankly, whichever regulator it might be, we'd expect there to be some degree of focus on in the coming reporting season.
Excellent. That sounds like a sensible idea. And I guess we know that the regulators talk all the time behind the scenes to work out the key areas that they're spotting in the reviews wherever they're taking place in the world. So there's a commonality of approach that takes place as they share their hot tips for what should be focused on. So we have the annual review of corporate reporting, and as ever, they have included in their report a sort of their highest priority areas, those areas that lead to the most common observations to companies. Is there anything in there that caught your attention?
The thing that stands out, maybe for the wrong reason, is that the number one in what I might call the regulatory hit parade is judgments and estimates. Again, It was last year, it was the year before. As far back as I remember, the area of most challenge from the FRC, at least, has been around disclosure of judgments and estimates. It remains there, to be fair. There are steps in the right direction in respect to the disclosure companies give, but it is an area of frequent challenge where companies aren't specific enough about the judgments they're making. Simply saying, for example, determining whether an entity is a subsidiary requires the exercise of judgment doesn't tell anyone a great deal. Because so what? What needs to be disclosed is where there is a specific judgment on that entity right there. For this particular reason, that was quite a significant judgment in concluding that it was a subsidiary or a joint venture or associate or whatever it might be. And when it comes to estimation, the principal concern is around the sensitivity of estimates that are made to variation. So here are some assumptions, and by the way, you should be disclosing the key assumptions, not just the ones that a certain accounting standard requires you to disclose. It follows, therefore, that the most significant assumptions for an impairment test aren't always the discount rate and long-term growth rate.
Indeed. Margins might be one.
It could be. But, okay, here are the assumptions. What sensitivity is there around these assumptions? And maybe for impairment a bad example, because companies seeking to comply with IAS 36 might give that sensitivity anyway, but actually IAS 1 says that wherever there is a significant estimate, or critical estimate, or key estimate, whatever phrase you might use. And that is one where there is a significant risk of material change within the next 12 months. You should be disclosing what's at risk here. So what's the sensitivity, or what might be the range of possible outcomes? And that's a disclosure that maybe some entities, some preparers are a little bit nervous about giving, particularly when it comes to things like litigation provisions or similar matters. But nevertheless, this is an area where FRC and others are looking for better disclosure to be given.
I think that's a very fair point, and I guess if I look across some of the sectors that the FRC have focused on in the last 12 months, they've had a particular focus, for example, on long-term contracting. And long-term contract accounting is one of those areas that does give rise to significant estimates where numbers can move materially by the next balance sheet date. So I think we have seen a lot of evidence that the FRC's focusing on entities that are affected by this and saying, can you enhance your disclosures?
That's right.
So, but in terms of the judgments and estimates, I guess the FRC did say that companies are getting better at distinguishing between what is a judgment and what is an estimate. So it has improved, but the more nuanced points, the area of greatest focus is likely to be disclosure of appropriately labelled critical estimates and how they might how the sensitivities might evolve.
That's right, and we'll no doubt in a little while be talking about the new standards that were adopted in the most recent round of annual reports, and the new one that's going to be adopted in the year coming up. But FRC and ESMA and others are keen to impress that those new standards involve judgment and estimation too. And amongst the most significant criticisms, although maybe criticism is too strong a word, of entities adopting, for example, IFRS 15, has been that companies are not being specific enough about what the accounting policies are, what really were the judgments around, for example, principal versus agent. Don't just quote the standard in saying a principal is this and agent is that, because that doesn't help anyone. Be specific. And when it comes to estimation, if you're considering the financial statements of a bank, expected credit losses, the impairment provision is a pretty big estimate that's being made, and it's a complicated one. How specific are banks being? Maybe the big ones were actually did a really good job there, but are all banks being equally specific around the estimation that's being disclosed and explained?
Indeed, so that's judgments and estimates, which, as you say, has been number one for a little while. Elsewhere in their top 10, which they very helpfully list in their report, anything catch your eye?
Well, it's interesting. There's one that isn't there, but we've heard from FRC that when it comes to challenging companies, often the most complicated cases concern questions of control.
Yes.
So should an entity be consolidated as a subsidiary, or is it a joint venture where you have a joint venture? How much clarity is there around the judgment exercise over the relative weighting of the different rights that each party might have? So that surprised me, because
the standard hasn't changed.
The standard hasn't changed. IFRS 10's been around for a while. It's nothing new, and it's never appeared in one of the top 10 lists in previous years. But there it is: control questions being pulled out by the FRC as being not necessarily the most numerous, but certainly the most complicated. Other areas that appear, tax is increasingly drawing attention. This was something that ESMA really drew attention to back in the summer, the ESMA concern being around recognition of deferred tax assets in respect of unused tax losses, reminding entities that there needs to be a good assessment of the probability of future profits being available, and convincing evidence needs to be available as well, where there has been a history of losses, which, if you've got unused losses, must suggest there have been losses at some point.
Yes, indeed.
So there's going to be a degree of challenge around any entity, I suspect, that's recognising deferred tax assets in respect of losses. How good is the disclosure of the, here we go again, judgment that's been exercised on the recognition of those assets, and the calculation thereof and the estimates of future profitability. Also, in respect of tax, there's a reminder that whilst IFRIC 23, which will be adopted this year, is new, and what I'm hearing is that for many entities, it's not prompting a great deal of change to the numbers. There's a kind of subtle reminder in IFRIC 23 that, by the way, this might involve the exercise of, here we go again, judgment, or maybe you're making estimates, and there might be an expectation that there's going to be a bit more disclosure in that area in the next round of annual reports. So tax is one that is worth looking out for. Cash flow statements.
The old chestnut.
Yeah, is a bit disappointing because the FRC view is not pointing towards something terribly complicated. It's just that they're seeing more mistakes. Particularly, it seems, around cash flows that seem to involve joint ventures. Payments to, receipts from, investments in, redemptions from joint ventures seem, sadly, frequently to be misclassified as between operating, financing and investing.
Yeah.
There are other examples the FRC cites of cash flows being misplaced or miscategorised. But as a connected issue, and this might stray us into another topic, not so much the cash flow statement itself, but a broader discussion of cash and liquidity is an area that, depending on where the listeners to this podcast are located, might well be front of mind around the liquidity of an entity and the information provided on risk, financial risk in particular, and liquidity and sources and uses of cash. A particular focus area for the FRC is the use of reverse factoring or supplier finance. Again, no new accounting standards there, but there is a quite clear desire amongst investors to see enhanced disclosure and transparency around the use of such arrangements. And the FRC has been quite transparent itself in its annual report in saying we expect companies to disclose the existence and use of these arrangements. Without reference to any particular accounting standard, they just expect it to be transparent because questions are being asked, rightly or wrongly, about the absence of disclosure where it's common in a particular industry. If you've got entities 1 to 7 all disclosing the use of supplier finance and entity 8 doesn't, it's in the same industry, questions start to be asked. So,
indeed they do. And I guess if we think about the economic cycle, across Europe, economies are tending to slow down, which puts more strain on companies and is shining a light, I think, on the disclosures on cash, liquidity, and indeed going concerns. So it doesn't take much of a crystal ball to say that that's going to be a priority area for the FRC and regulators around Europe in reviewing this set of financial statements that are coming up.
That's right, and this is a good segue into the area of risk generally. I've talked about liquidity and sources and usage of cash, but the clarity of the reporting in the what we call the front half or narrative section of an annual report on the risks that an entity is facing and how they're being mitigated, where such disclosure is warranted, is increasingly important. We're recording this in November in the United Kingdom, and of course many companies are disclosing the exposure they might have to the uncertainty we're currently facing around Brexit, what will happen and when that might happen. There is also a rapidly increasing focus on the impact of climate risk on companies. There will likely, I suspect, be, in the UK at least, new reporting requirements in years to come, but within Europe, the non-financial reporting regulations or non-financial reporting directive that's been implemented in different ways in different countries is clearly being seen as a segue into better reporting, not just of companies' impact on the environment, but the environmental impact on companies as well, so-called double materiality concept. And there is a very clear message coming out of the FRC that there should be clearer disclosure of the exposure that companies have. What are boards doing to take account of the resilience of the company in relation to climate risk, and what are the risks, uncertainties and viability in both the immediate and longer term as the challenge of climate risk is facing everyone.
And indeed they mentioned climate risk in their impairment thematic to say this is something that companies should be mindful of. Does the change in climate have an impact on business models, and should companies be thinking about it when it comes to impairment testing? So it's endemic through the financial statements. And I guess coming on to thematics.
Well, one final one from the top 10. It wouldn't be a conversation of comments coming out of regulators without mentioning alternative performance measures or non-GAAP measures or whatever you choose to call them. And that they do loom large again. The view from the FRC is that actually the presentation and disclosure of APMs is getting better. The ESMA guidelines, which are now in their 4th or 5th year in a row for a while now, making a difference such that there is now much better disclosure of the measures how are they labelled, how are they used within the entity, how are they reconciled to the equivalent gap measure, are they used consistently, all the various good practice guidance. But nevertheless, FRC has made it known that they will challenge companies that apparently don't follow the NESMA guidelines. So, for example, if they don't reconcile a non-gap measure to the equivalent IFRS measure, there were some quite harsh questions asked as to why that is the case. Equally, if something is described as non-recurring for the 5th or 6th consecutive year, that might attract a bit of attention too.
So APMs, indeed APMs were subject of a thematic review a couple of years ago, which I think was the FRC firing the starting gun on their focus on this area. But they've continued with their thematic reviews elsewhere. Are there any particular messages coming out of the fall that we have seen in the last few weeks?
The new standards we've already alluded to in the context of judgments and estimates. And when it comes to IFRS 15, first of all, the thrust of the feedback on IFRS 15 is for companies to do a better job of articulating the policy in a specific way that relates to the actual revenue streams of the company or the group, and not just the wording of the accounting standard. But also the judgments that have been made specifically in the estimation where it might be relevant. A little bit of focus on the balance sheet and contract balances, and a little bit on disaggregation as well, but at the heart of the IFRS 15 thematic is really around the judgments, the estimates, the policies. IFRS 9 is largely focused on banks, credit institutions, where the feedback is mostly around expected credit losses, unsurprisingly. The methodologies and the clarity of those methodologies, the transparency of the policies around calculation of expected credit losses and the disclosure thereof. When it comes to non-banking companies, some interesting points made in the thematic, including, for example, can companies please make sure that they remove all the old IAS 39 terminology? If the impact of IFRS 9 was considered to be immaterial, but it doesn't appear so from the numbers, why is that? So some things which might seem rather obvious, some companies it would appear missed. Now, okay, IFRS 9 is now adopted, you can't really go back and do that again. But there's an opportunity with IFRS 16 coming up to learn from the IFRS 9, IFRS 15 experience and put those learnings into play. When it comes to IFRS 16, the message is similar to the messages that were given around IFRS 9 and 15 a couple of years ago. So please be clear about how you have transitioned into the new standard. Again, what were the judgments you made, for example, around lease term, around discount rate? How did you make those judgments specifically, not just quoting the standard? What expedients have been used, distinguishing those that are something to do with transition and those that will be used on an ongoing basis. An easy example there is an practical expedient on first-time adoption for leases, however long, but which only have 12 months or less to run on the date of adoption. There's a separate one for short-term leases which can be applied on an ongoing basis. Are you applying both of those, one of those, neither of those? Just saying an exemption for short-term leases could be either, so or leases with less than 12 months. A real focus for those, and frankly it's the majority of companies adopting the modified retrospective approach, to explain how the old IAS 17 operating lease commitment morphs into the new IFRS 16 liability.
That's the reconciliation that's required.
Well, the standard doesn't require reconciliation, but it might be the best way of doing it. An explanation is what is required. So how do you get from A to B? And if getting from A to B includes one stop called discovering some leases we never knew we had, that needs to be explained somewhere. And there have certainly been over the past few years many companies actually who have been quite upfront in saying in their operating lease commitment that we've revised our operating lease commitment disclosure because we've identified some leases as part of the exercise to adopt IFRS 16. So be clear about how you get from A to B there. Also, again mentioning it's the majority of companies following the modified retrospective approach, that will mean that the current year numbers might not be comparable from the last year's numbers, and if you have substantial numbers of leases and EBITDA is a key performance measure, then this year's EBITDA won't be comparable with last year's EBITDA. And in fact, in many cases we're hearing of EBITDA becoming EBITDA with an R on the end, or after leases or some other measure. So first of all, if you are changing your APMs, explain why and how. If you're keeping the same APMs, then to the extent that there has been a significant movement caused by a new accounting standard that isn't applied in the prior year, that needs to be explained clearly.
Excellent.
Now, when it comes to IAS 36, the thematic was not prompted by a new accounting standard, but very much prompted by the current economic environment and some feedback from investors that the disclosure around impairments could be improved. And consistent with a theme that we've had throughout this conversation, some entities could do a better job of explaining the estimates, the judgments they've made, and the estimates that or the assumptions they've applied, which would go beyond just the long-term growth rate and the discount rate. On the whole, most companies did something as well. There were a lot of really good practice examples in the thematic review, but nobody was perfect. So it's around the assumptions that and the sensitivity of those outcomes that the most interest. One interesting point, which might be not applicable in every territory, because not every territory would include in the consolidated accounts the parent company's balance sheet or accounts. But FRC has started asking questions where the parent company's investment in subsidiaries is more than the market capitalisation of the group. So if the group as a whole, in the eyes of the capital market, is worth 100 million, and the investment in the parent company's accounts is carried at 150 million, that begs the question as to, well, first of all, that's a prima facie, that's an indicator of impairment, so impairment review should be done. But if you haven't explained how you've got comfortable that it's not impaired, then FRC might well be writing you some letters.
Excellent. Yes, and so actually, one of the reflections I would have on the thematic reviews in general, and you did allude to it in that one, is that for companies who are looking for examples of good reporting, the FRC have helpfully included in the thematics they have done extracts from disclosures of accounts where they think people have done a good job in particular areas, whether it's accounting policies for revenue, whether it's the lease transition disclosures or whatever. So for anyone who's preparing financial statements, they're an easily accessible, short and helpful read.
Yeah, I would agree with that.
We are almost out of time, but I just wondered if you've got any sort of final reflections on, are there areas we haven't yet discussed where we think the regulators, whether in the UK or Europe, will be focusing over the next 6 to 12 months? Are there any sort of developing areas that are of concern, or is it going to be kind of more of the same?
The new leases standard will clearly be an area of focus, as will in the UK and maybe some other territories, some changes in narrative reporting requirements. We're quite a few in the UK, and as is always the case when something new is applied, then regulators like to examine how that has been adopted. The message I gave earlier on around risk, I think that we live in uncertain times, and uncertainty breeds risk, and there's nothing the capital markets like less than a surprise.
Yes.
So I would encourage any people listening to this podcast responsible for preparing accounts to think carefully about just how transparent the risk disclosures are, and particularly in areas where there might be an expectation of a particular exposure, like climate risk, like the risks associated with the UK's decision to leave the European Union, maybe to do with liquidity and financing, and have a good think about whether more could be done to be clearly articulating what that position is. And in the back half of the accounts, I think the parting shot ought to be what I've repeated several times through this conversation, that the disclosure around judgments and estimates are probably one of the more critical areas of the accounts. It shows actually, here are the numbers that prepared, but how far away were we from preparing some different numbers? Yeah, and that's quite important information.
Excellent. Thank you, Peter, for your time today and sharing an update from on the regulatory horizon. And so thank you everyone for listening. If you require information, financial information or accounting information in the meantime, then have a look on PwC Inform or pwc.com/IFRS. And in the meantime, a happy accounting.
The preceding programme was brought to you by PricewaterhouseCoopers LLP. This content is for general information purposes and is not a substitute for consultation with professional advisors.